Hello, I'm Niels Christensen. Welcome to the Minds of Money Online Connect Virtual Mining Conference. Happy New Year. Today we have a really interesting panel discussion talking about the gold price, everything that's affecting the market, and maybe we'll get into some miners. We have really good panel discussion. Today we have Dr. Torsten Dennin, Chief Investment Officer of Asset Management Switzerland. We have Markus Bachmann, Chief Executive Officer and Fund Manager at Craton Capital. Willem Middelkoop, Chief Investment Officer of Commodity Discovery Fund. Daniel Oliver, Managing Member of Myrmikan Capital. Sorry.
Thank you.
That's always a mouthful for me. I apologize. And Henry Steele, Portfolio Manager of Odey Asset Management. Gentlemen, I've been really looking forward to this panel. You guys are some heavyweights in the industry. Thank you very much for joining us today.
Pleasure from our side.
Great to be here.
Thank you.
Thank you. So it's been a really interesting start to the year. And I think a good way to kick off this panel discussion is to talk about your thoughts for gold. Right now, we're actually seeing the first negative start to the year since 2013. There was a lot of expectations heading into 2021. Has anything changed for you? Are you guys still bullish on the gold price? Let's start with Torsten.
Thank you. Yeah. So I saw you struggling with a last name. It's Dennin. That's easier to pronounce on that. And I was just thinking when you introduced me and said, how can you know that during the lockdown I gained weight when you introduced me as one of the heavyweights here in the round? Yeah. But anyway, I mean, the start in the year with the gold price, we've seen above $2,000 last year, a nice rally, and now taking a breather on that. I'm more focused on the physical side on the market. We have mining products, a couple of funds here, but most of our assets are more on the physical side, and people are trying to invest here as a kind of safe haven investment. And I must say, I'm much more relaxed than I was at 2,000, 2,100 on this approach, yeah, because it's a more healthy development. And the market outlook, looking ahead for the next 1 or 2 years, when I talk to clients on these fundamentals, I'm an economist by training. I'm a professor in economics and finance. And when you see all these boxes being clicked on the micro and macro side, debt levels, inflation, money printing, you name it, and it's all heading to one direction, it's heading to the gold market. So therefore, if the bullion market is losing $100 or not, it's not that significant. It's just a matter about it's just like a short or medium or a long-term development. And the long-term development looks quite fantastic for me.
Henry, what do you have to add to this?
Yeah, I mean, look, from my perspective, I mean, really kind of medium to long run, gold prices obviously are kind of a function of inflation and interest rates, kind of real yields. So, which again are kind of derivative of fiscal and monetary policy. We don't really look to kind of have any edge, any kind of view on the gold price itself in my funds. It's we kind of actually try and strip out the commodity price from the portfolio. So we definitely don't try and take a directional view on it. However, I definitely say from which I think we're going to talk about in a bit is kind of equities versus the miners versus the commodity. What you saw last year, very much there was a big derating of the gold miners. If you kind of look at it on most metrics, they're a lot cheaper on spot. And obviously the forward market is in contango, so it kind of assumes kind of small increase in the gold price over time, and kind of where we are today, in terms of kind of owning a particularly the kind of the large cap and many of the mid cap, the equity stories are very much intact where they were kind of this time last year. Probably balance sheets generally have obviously been repaired to some extent. And yet, on the other hand, the equities have derated quite a lot. So, we're very excited about, the equities, the re-rating of the equities, the kind of the stock-specific risk attached to those companies, to many of those companies, and it's on the longs and the shorts. Obviously today, many of you will have seen what happened with Fresnillo. there are some out there that experience kind of potentially kind of large asymmetric risk downside, even if the gold price and the silver price, precious metal prices don't move. So very excited on the equity side from the stock specific risk point of view, and pretty agnostic really on the commodity price itself.
I'm definitely looking forward to talking about the equity side, because I think there's value. Daniel, I apologize, I cut you off.
Yeah, no, I think that's right. The equity side, I think we're in the next segment, but I just wanted to go back and comment on the gold price, as you mentioned. I always turn that conversation around. The reason why gold is money and has been for 4,000 years is because it is the most stable element out there. So when people talk about the gold price, first of all, even though this is a European panel happening in Europe, people think about the dollar price of gold, because the dollar is the global reserve currency. And when the gold price is going down in terms of dollars, I look at it more, the dollar's going up. I don't think gold's moving that much. It's the dollar that's moving. And of course, that's ironic, because the market, and myself included, assumed a democratic sweep of the elections would result in a lot more money printing and obviously weaker dollar. That will happen, I'm pretty confident. But it doesn't mean that it happens in a straight line. But one of my recurring themes is, if you look at inflationary economies, whether it be Weimar Germany or Argentina or US in the 70s, one of the aspects of inflation is not just prices rising, but prices becoming more volatile. And if you think about the dollar, it's, I think, heading much lower. But at the moment, there's about $13 trillion of debt that need to be rolled this year. If the Fed doesn't print enough money fast enough, they're going to have problems. Now, the Fed is printing money. Their balance sheet had hit a record high again last week. You look at M1, which didn't respond a lot in 2008. That's gone vertical, and that also hit another record last week. So the monetary indicators are all full speed ahead, and it doesn't mean we can't have a deflationary impulse move the way we happened in March. But I think long term is pretty confident the dollar is hitting a lot lower and gold's getting a lot higher. So the lesson is, don't be too levered on your gold position, because leverage in an inflationary volatile market is a killer. But if you can hang on through the volatility, I think you'll find the gold price is much, much higher in the not too distant future.
I definitely have a follow-up question for you for money supply, dealing with velocity. But I want to continue with the panel. Willem, what's your look? What's your take on the gold price? And we were talking offline, and you actually said that even with a lower gold price, you're seeing really good inflows.
Yeah, I think something fundamentally changed within the market. Of course, we had this severe downturn starting 2011, almost a decade long. And we were waiting for a catalyst for the market to change. And that catalyst started, I think, in the summer of 2019. Mark Carney gave his famous speech in Jackson Hole calling for success of the dollar. And we also had the start of a new crisis, the repo crisis, which was neglected quite a bit in the last 12 months because of the COVID crisis. But the repo crisis actually was a funding crisis for the US. And you've seen gold taking off and breaking out since the summer of 2019. And we're in a new bull market. It's not just for gold, it's also for silver, it's for other metals as well. We've seen incredible inflows for our fund. We've never experienced this before. And it continues until this day. So people understand that gold is taking, well, just a technical pause. And people understand a much larger percentage of the investors, or I should say savers, are now entering the market as investors, because they do understand they have to put money at work. And that explains why Bitcoin is going up. That explains why broader markets are going up. So money is going down, and that's what we as gold investors have been warning about. We've been warning about this for 20 years. I personally have been warning about this for 20 years, and now it's finally happening. So it couldn't be better.
Markus, save the best for last. What are your thoughts on the price action that we're seeing in gold in the first month of the year?
I'm not sort of like overthinking it, Niels. It probably has to be seen in the broader context of a natural correction that we have since the high sort of mid last year, August last year, and I think we could well be close to the bottom of that move. It's very standard. Going forward, you probably shouldn't ask a gold manager what he thinks about the gold price. The answer might be positive. So try to take my macro hat, but I think there are many stars aligned, for gold to do well, being a very constructive environment. With regard to what happened since the beginning of the year, look, a lot of investors jumped on the reflation trade in the last quarter of 2020, and with the virus coming back with a vengeance, and sort of inflation expectations probably have been a little bit tamed, and therefore it's quite natural that the gold price haven't shot through the roof. I think we need to settle a little bit and see how it evolves if the cases are coming down. The lockdown regulations that take place everywhere, that sort of like tame economic activity. And what I'm also kind of very interested in to see kind of like the lending activity. We always talk about money printing, but it does actually nothing to inflation if that money doesn't come into the real economy. And it only comes into the real economy once banks actually start to lend. And that hasn't been the case. You briefly mentioned velocity of money. That's been absolutely shocking. It's other than in the US, I think we get to all-time lows every quarter. And it will be interesting to see over the next couple of months how that evolves. But if you ask me over the next 6, 12, or maybe 24 months, I think cautiously optimistic and quite constructive also in the long run. I think people do not realize yet that we are actually, and Willem mentioned that, we are in a new upcycle. And the length of these upcycles are often underestimated. We're not talking about 1 or 2 year cycles. They tend to last between 7, 8, 10, 12 years even.
Okay, so I want to get into this idea of monetary velocity. I mean, in 2008, a lot of people were saying QE. The first time we saw QE, this is going to lead to massive inflation. 10 years later, we didn't get anything, and I'm sort of wondering what makes this time different. What's going to create the velocity? I mean, there's no question that the printing presses are overheating, running overtime, but what gets that velocity? And do you see that velocity coming? I'm going to put this to Dan first, because he brought it up first.
Right. So I think of it a little bit differently. In 2008, they printed money. What they actually did is not the Bernanke, Milton Friedman threat of throwing dollars at helicopters, right? They gave reserves to the banks, and the banks took those reserves to bail out their old loans and make new loans. And those loans go for building assets. And so there was a huge bubble, a huge credit bubble, asset bubble, and what you get when that happens is overcapacity, right? Because you build too many buildings, too many factories, too many ships, too many airplanes, and that actually causes consumer prices to fall. And that's why we haven't seen the inflation I was worried about, because of all this overcapacity. What happens eventually, of course, in the standard Austrian business cycle theory, is that overcapacity lowers prices. Those projects can't make their payments, and then you get a credit crisis. And as someone mentioned, that was beginning to play out as early as 2019. This is very different. This is people not allowed to work because of the lockdowns, and the governments are sending people direct checks. This really is the helicopter money. So you get this money in your checking account, and you can go buy things. So you look at the price of food, you look at the price of I went to the bike store the other day. Prices are up 30% year over year, not 2% of CPI, 30%. So when you look at consumer goods, people are buying with their money, their checks are getting straight from the government. It's sending consumer prices up. And the way I describe this is there's a big difference between a credit inflation, which increases asset prices, and a debasement, which increases consumer prices. And the difference between 2008 and now is that story, and the story really since the 70s was a credit bubble, credit asset story. Now the money printing is going into consumer prices. So I think that's when we're going to start seeing if you want to think of it in terms of velocity, I don't, but if you want to think of it that way, all that M1, there's M0 was the story before, now it's M1, that's checkable deposits, cash you can spend directly, and that's going to send consumer prices soaring 70s style, I think.
Markus, what do you think? Do we get? Do you see velocity? Maybe we see it in the second half of the year when most economists are expecting the global economy to pick up?
I don't know, Niels. It will depend, and I think the missing link so far, also since 2008, were the banks, because the bank lending actually has been pedestrian at best. And without the banks actually coming to the party and actually, fuel the economy with credit, nothing is going to happen, and velocity continues to go down. It will be interesting to actually encourage the banks to lend to, to the consumers and to corporates, or smaller corporates, that is mainly. And it will be very interesting how that plays out within the entire COVID environment. And I think one way that has also been portrayed in the market and mentioned are credit guarantees, straight credit guarantees that, the UK government or the German government actually will go to the banks and said, look, we would be quite happy if you would be less stringent in terms of your lending, if you're actually going to be more generous, and we guarantee you parts of that lending, or if not all of it. And I think you need to encourage the banks, or actually twist them or force them actually to be more generous with the lending. And once, that credit flows into the economy, then we potentially will see kind of patches of inflation or higher inflation. And I think that's also what the central banks want, because what we haven't talked about is literally the big debt bubble in the background, the biggest on record, and that's on mainly also on a government level, on a private corporate level as well. And somehow we need to get out of that, and that only will work actually with some inflation in the system and low interest rates. And so all these links actually, they must actually click together. And if we see that, we will see, improved velocity of money. That's the key for inflation. And then maybe down the road in 6 to 12 to 18 months time, we will see the first signs of higher inflation. But I think the key is the bank lending.
Does anybody else have any other thoughts they want to add on inflation? I have a lot of questions. Willem, please.
Yeah, once a week at least, I'm checking the price development of the soft commodities, so the corns and the soyas. And if you look at these graphs, they're exploding in the last few weeks. So there you have it. There's the start of some real inflation in food prices. Mm-hmm. And I think this will be a huge story within 12 to 24 months. And the Bank of China also pointed at this even this morning. So I think inflation will become a huge story. We know from the commands from central bankers that they want to push up the inflation to make up for lost inflation. The madness out there is getting remarkable. And I think people, the general public, they understand it. And we're a retail fund. We have over 1,000 retail investors, and there's such a change in sentiment. And so like I said, couldn't be better for us hard asset investors.
And if I can just jump in, the last time food prices spiked, the Middle East ignited in revolutions and war and civil war, and I think that'll happen again. Although it may not just be the Middle East this time, maybe other countries too.
Yeah. I don't really want to talk about grocery prices. I've seen my grocery bill rise since the start of the pandemic. So I think definitely inflation is out there. How we feel it, and not only inflation, but purchasing power as well. I mean, what are your guys' thoughts? Maybe Torsten, you can talk. Like a U.S. dollar. I mean, it feels like we're coming from inflation from both sides in currency debasement and price appreciation.
On both sides, I would add to that. Yeah, I first was thinking about. I don't want to give you like an introduction to this quantitative theory of money and to explain why this ultra low velocity of money, like basically zero, in the moment is causing that you don't have any inflation. This is like stuff for my econ students. But you see the result everywhere in the market, right? Inflation, like consumer price inflation, is basically non-existent. Thanks for this comment, William, about the agriculture stuff. I think this is just like a beginning what we see here, because when you look a little bit the broader picture and look back in the 70s, what happened to agriculture prices in the 70s is also like debt was getting out of control, inflation was shooting up, and economic growth was stagnant. Therefore, the term about stagflation, what we had here, like the prices of wheat, corn, and soybeans was not only rising by 10 or 20%, it was quadrupling, fivefolding, sixfolding, and so forth. And this is the inflation that is missing in the system. I would disagree about how we're getting out of this debt situation by just inflation. I mean, this is one example, especially like the UK made a good, I think, good experience with that in the history. But from another perspective, when you, for example, look at Italy in the moment and follow the discussion in political Italy, you see all these huge billions and fantastic zillions of money you get for the COVID treatment of the economy. Nobody who seriously thinks is thinking that Italy is able to pay it back. And I think just like a handful of countries are really seriously thinking about repaying this kind of debt. And it's not about inflation, it's more like finding like a clever way, maybe like in the new monetary theory, just to get rid of this, yeah? So like, okay, the central bank and the government, and then the normal investor, normal people on the street, they're not getting fooled by this. And this is, I think, why I think the retail side also increases on the gold side and the gold stocks, because there has also the time where gold physically was prohibited to own. So gold stocks is a good hedge on that, but also like some other trades besides the hot assets, we're already seen increasing, like equities, bonds, real estate, with prices like shoot up in the asset inflation already, right?
Henry, I guess, do you have anything to add on the inflation front?
I would say, following up kind of just adding to what Dan said earlier, there is also, another key thing that this time you don't have the counterbalances. Remember that last time, 2008, 2009, it was the banking crisis that caused that reaction. And reserve ratios were obviously tightened up a lot after. So there was a lot of money being drained out of the system on the other side. You don't have that this time, so there aren't those same counterbalances. And then I would also add, I think inflation, policymakers want inflation. It redistributes wealth to a very large extent, and it's very clear that we've had huge amounts of wealth inequality created from the monetary stimulus package that we've had through asset price inflation. The haves have become even richer, and the have-nots have been given some cash to deal with it short term. But one needs to have that inflation to come through. It kind of makes, from a social perspective, it makes sense. So I think it will be very much welcome by the policymakers.
If I can add one more point before we move on, and that is going back to the 70s. The prices of commodities tend to spike around events. So think of the oil price, right? Everyone still, history books, economists talk about, well, the embargo, the wars. But that's not true. If you look at oil prices in gold terms in the 70s, it barely moved. So the point is that what those events do is they reset oil prices where they were going anyway with the monetary conditions. And the reason I bring it up is because when you look at prices today, there are all kinds of supply chain issues and prices going up. And the explanation is, well, especially in the steel market, it's a supply chain issue. When the supply chain issues go away, the prices come back down to where they were before. My point of the 70s analogies is I don't think that's the case. I think that the supply chain issues are putting prices at a new plane, and they will never go back to where they were before, because this new level is reflecting what's already happened on the monetary side. And also, in terms of inflation wiping away in debt, that's a great policy, aggregate macro theory. The reality is what happens, and again, if you study inflationary economies, is that, for example, food prices go up before wages do, right? So inflation is great on a macro scale, but when you're living through it, right, the consumer gets crushed because their wages are always lagging the increase in prices. On the business side, what happens is you sell your product, you go buy a resupply, and it turns out the resupply prices are higher, and so that eats up the working capital. So it doesn't all happen. It's not a genie that runs around and changes all the prices one day and the debt disappears. It's a process that wipes out large percents of the population. And of course, the people who escape unscathed are the very rich who can prepare themselves, and that creates more wealth disparity, which again is what you see in more third world countries that wrestle with these issues more often than the West does.
Thank you, guys. Thanks for your thoughts on inflation. Sort of moving forward, Willem touched on this a couple of times, and and I want to bring this up. Retail versus speculative. I mean, I think a lot of the price action we're seeing is because a lot of the speculative money, in the COTs and the CFTs data, that's moving out of the markets. But we actually are seeing inflows into ETFs still. Inflows are still positive, and so I'm sort of wondering. I mean, is this now? Are we in this stage now in the market where it's retail versus investment capital? I mean, and it does feel like if we are in this, then retail can drive prices higher. Who wants to go first?
I hope you're not thinking about the kind of Robin Hood style of a gold industry, right?
Retail,
so all the retail goes into the industry and following it like a Robin Hood trade is supposed to be on the stock side. On the side, I mean, compare the outflows that we've seen 2 weeks ago, right, on the Friday to take a kind of taking profit.
Mm-hmm, mm-hmm. Willem. Oh, you're muted. Sorry, you're muted.
Unmute. Sorry for this. This is a gold panel, but I'm always very interested in silver because that's poor man's gold. And once the Robin Hood crowd finds out what the situation is in silver, but it could also happen to uranium. It could also happen to platinum. These are very, very small markets, tiny markets. And I think we'll see huge runs as we have seen in the last few weeks with lithium. And I think we'll have these runs once in a while in different metals. And this will attract a great deal of retail speculative money into our space. And on the other side, we'll see institutional investors which shied away from commodities in the last decade, one could say. Most of our peers in London collapsed or lost almost all of their assets under management. And they have huge pressure now, I think, from their clients, the pension funds. They have huge pressure now, I think, from their clients that they need to invest some of their money in commodities. And I was at a conference pre-corona, and I asked this JP Morgan fund manager what percentage of his funds, of this general fund, were in commodities. Is less than half of a percent. So if they start to invest some of their institutional money into commodities, let's say 2, 3, 4%, which would be totally logical, we can have some real strong moves to the upside.
I think now is a good time. We are getting questions from the audience, and if any audience they have questions, please write them in the chat, and we'll try to get to them. So one question we have from the audience is actually for Willem, and I'm going to bring it to all of you as well. But you wrote a book called The Great Reset, talking about where gold reestablished itself as a pillar in the financial system. When does that happen? Are we starting to see that happen? And I guess the broader question is, what are your thoughts on a new gold standard? Is this something that happens, or is it maybe just we use gold to strengthen our currencies?
Well, actually, I would like to. Yeah, actually, I would like to sue Klaus Schwab of the World Economic Forum, because the title of my book was The Big Reset, and he stole it and he transformed it into The Great Reset. But my book was published in 2014, and it's free to download from our website. But in this book, I said there are 3 main problems which need to be solved. We need to find a new anchor for world's financial system, so a successor for the dollar. Mark Carney agreed in 2019. So there's no more debate needed. We also need debt restructurings, and with the new administration in the US, the first steps were set into that direction, because the student debts are being postponed right now. And I also said that we could expect a gold revaluation and gold becoming more important in the system. I don't know if we'll return to a full gold standard, but the revaluation of the gold price will be by market forces like we have seen now in the last few months, or it will be a decision by central bankers. So revaluing gold means devaluing dollar. That has happened before. Look at the 1930s, look at the 1970s. And all this is playing out now. Well, the Great Reset the World Economic Forum talks about is a much larger change to important systems, which we are used to after the Second World War. And people always ask me, because I wrote the book in 2014, when will the reset start? Like it's Sunday in March 2022, but the reset has started already. When we will look back in 2030, we'll conclude that so many changes to the system have happened over the last 10 years. So the reset has started for me.
So rest of the panel, what do you think? What role does gold play in the financial markets?
Yeah, if I can jump in there. I mean, I think one has to separate economics from politics. What I mean by that is gold is the foundational monetary medium. Still, it never stopped being that. Politicians can't override that. And for evidence, I can point to the fact that not just is oil more or less the same price today as it was in the 60s, but if you look at the volatility of oil in gold prices, is lower than it is in dollar prices. So if you're in the oil business, you should really be looking at oil and gold and other commodity business. You would look at gold as their anchor, because their products become less volatile and consumer products start as commodities. And so gold really still does behave that way. What I think that people get confused about is the politics around it, right? We don't say that we're in a gold standard anymore, so I think we're not. But if you think about the Federal Reserve, when Bretton Woods was set up, the Fed's balance sheet was 85% gold. So basically, the U.S. dollar was a substitute for gold. The Keynesians who took over the monetary management politics printed the money. That ratio got down to about 11% in 1969. The Nifty 50, the 60s bubble, all those sorts of things. And what the inflation of the 70s did, what the gold price did, is it went from $35 an ounce to $875. And at that price, actually around $650, the Federal Reserve was 100% backed by gold. There was no politician, no economist would say we were back at a gold standard, but the market had done it. The US dollar at that moment was essentially a gold-backed instrument. Now, obviously, then the monetarists took over from the Keynesians, based the same people. They printed the money for the last 40 years, and now that ratio has gone down to about 7%, even at current prices. So my point is that gold today is cheaper than it was at $35 an ounce in 1969. And the way the market will do it, forget about the politicians, what the market will do is revalue gold to make currencies gold backed again. And that means the prices in dollar terms have to go well above $10,000 an ounce. So that may sound crazy, but in the 70s, it went up 35 times, and the monetary abuse is much worse now than it was then. So I think we can see similar moves to that going forward. When that happens, that's the bubble collapsing. That's a hard time to pick. Most people try to short the internet bubble, didn't do so well, right? Because it's very hard to time. But that doesn't mean it isn't going to happen. It will happen. And when it does happen, it will be very, very dramatic.
Markus, you've been quiet here. What are your thoughts on gold in the global financial system?
Look, I completely echo what Daniel said about gold's role. Gold's been there for the last 3,500 years as a part of the financial system. And it will be there for many hundreds of years to come. I think the market will decide where the gold price is going to be. It's not up to the central banks. It's not up to politicians. And I think gold is still very much a misunderstood asset. But in that sort of like scenario that unfolds going forward, I think its role will be much more important. And its probably role as a pillar of the global financial system will be strengthened through, the debt explosion that we have through currency debasement, etc. And it will be interesting to see how it sort of like plays out. But it's very difficult to add a price tag on the future price of gold, but it is probably much higher than most of the market participants actually at the moment think.
Should we get a comment from the professor on this? What's what, a lot of it is theoretical. So, I mean, what does a gold standard look realistic?
This almost sounds like Money Heist. Yeah, the Netflix series on that one. I would like to steal some of $1 billion here. But I was thinking about when we talk like twice now about the 70s. And when you look in the 70s, I think everybody in the audience remembers communism and the clash of the systems. When you look at the economic side of the deal, I think the 70s marked like the biggest economic experiment of economic history in mankind. And this is like the monetary system that was created in the 70s after the Nixon shock, when money was basically debased from anything that has a substantial value. We had the gold standard, and to be short on that, I don't think the gold standard is coming back on that, because you can't put the thing back in the box. It's entropy. Yeah, the animal left the cage. But after the gold standard, we moved to the supremacy of the US dollar, the level of trust. And then with the Nixon shock, we have like the total debasement that there was no anchoring anymore. And when you compare from the 70s onwards to today, like the excesses of debt creation, how government found creative ways to create debt and basically never ever to pay it back on that. So in the moment, without counting the last billions of the COVID catastrophe we are at a GDP to debt level of somewhere between 320 to 340% when you count like student loans exactly, household debt in total, corporate debt, and the government debt. Yeah, so therefore, it is a system crisis that we see here. And the system crisis, I agree with you guys on that. You see like much higher gold prices as an anchoring. And there are lots of ways how people are getting out of the system, out of the monetary system we are living in. Yeah, gold or precious metal, physical or with stocks is one way. There are like a couple of other ways. And you see like these kinds of asset prices increase on that.
Last word to you on this subject, Henry. What are your thoughts on gold as a global asset in the financial system?
Yeah, look, I think as real yields, continue to fall, and as we see, if and when we see inflation kind of continue to rise, and coupons, zero coupon bonds, negative yielding fixed income, gold has more of a purpose in many different ways. It is, as everyone has said, fundamentally a store of value. And in terms of kind of capital flowing into kind of going back to the retail versus institutional, the other interesting thing is, that the risk parity funds out there, that hold kind of fixed income against equity. There is a lot of leverage. There's a lot of AUM in those funds, and there's a lot of leverage in those funds. And gold becomes, a more favorable instrument to use rather than bonds. So, it could be, if we continue to see this, we are kind of at that tilt edge of a lot of capital flowing, institutional capital flowing into gold because of the nature of the asset.
Yeah, you make a really good point. I mean, if the 10-year goes up to 1.5%, like how is that a yield? Like, what's the difference between a 10-year bond? It sounds like a bad joke. What's the difference between a 10-year bond and an ounce of gold?
Yeah, and on that point, in the 70s, because I think that's a good analog, when nominal yields were rising, real yields were falling. And it's a strange thing, but as nominal yields went up, inflation really kicked up. And my explanation for that is that as yields go up, the bonds the Fed holds collapse in value, and so the dollar loses its anchor. But in any case, so I wouldn't care too much about what happens to the nominal yield of the 10 years. It's what happens to real yields that matters. And I think we all would discuss. I think inflation is already here and going to get worse.
So Henry, did you just have a quick comment there, or?
Sorry, no, I was going to say absolutely, yeah, I completely agree with that.
Okay, so this is a gold panel, but Bitcoin is taking a lot of attention away from the precious metals, or it feels like that. So I want to ask this panel, thoughts on Bitcoin. I mean, is this new gold? Does this replace gold, or should these two assets be working hand in hand? dealer's choice. Who wants to take this one? Markus.
I'm happy to take that one. Both have their place in a global financial system. I think what we see in terms of regulatory attempts, to regulate Bitcoin is actually a positive for the asset class, because it will give institutional investors the opportunity to actually invest in Bitcoin. Very interesting to see also that when we look at the expansion of balance sheets of global central banks, actually Bitcoin, or the price of Bitcoin, has the strongest correlation with that expansion. It's actually not gold. So Bitcoin has outperformed gold by a margin. I think both assets are very vital going forward in the global financial system. Maybe sort of like our age segment is probably favoring gold. But there is a new generation of investors that is very familiar with cryptocurrencies and will probably and most likely happily to invest in Bitcoin. And it will be very interesting to see the institutional flows into Bitcoin going forward. And that could potentially drive the price much, much higher. But that's not a forecast. That could be sort of like a scenario that I regard as possible. Back to you, Niels.
Torsten, I want to pass this on to you. This was your question as well that you wanted me to ask. So, gold versus Bitcoin.
Yeah, it's like the tale of two cities. Or when you compare like gold and Bitcoins, I think the argument about the two sides of the same medal is a bit stretched, but there's some truth in here. Because the underlying investor demand is to have a way out of the financial and monetary system that we are living in, a way out, and a hedge. And both is a way of hedging your exposure. First, about a decentralized, like a cryptographed currency. Second, on gold that has like a 4,000 to 5,000 year of history. Yeah, when I first started about thinking about the Bitcoin side, and I said, you guys know Bitcoin is like 12-year-old, right? Would you like entrust like $500,000 now to your 12-year-old kid to run away with? The history is missing, and of course the history only comes with the next years. So if you ask me about investing now or investing in the last months in Bitcoin, it is an asset similar with a similar proximity to precious metals. So therefore we see it as basically as partnering and up, but for different kind of investors, because volatility obviously is a different one. Yeah, I have so many investors asking me about, look, Bitcoin was going from 4,000 to 40,000 within 12 months, and now coming back 25%. Does it mean it's a crash? And it's a correction, like we've seen a correction in the gold market. So therefore, time series is a bit overstretched. And I see one important, I think, differentiation to the 2017 crash. Probably some of you might see in From Tulips to Bitcoin is one of my favorite books I've wrote myself in the last years. So don't be too shy on that, but I think it's a really nice one. 2017, the crisis here was because the Bitcoin collapsed because of the Chinese getting out of the yuan and about some other financial factors. And now I live in the canton of Zug, in the city of Zug in Switzerland. I can go to Starbucks and pay with Bitcoin. I can go to the office to official purpose and pay, for example, for my wedding. This year, I also can pay with Bitcoin for my tax declaration. That's quite new. So therefore, the difference is mass adoption. And I think this is the argument Markus said about the big money, the institutional money, when I have it right in my head on the gold side. This is now the side about the institutional money going also in the cryptos, because both is a way out of the system about global rising debt, inflation, and probably exponential rising graphs that nobody who has a clear mind can see as sustainable. Yeah, so that is my stance on that question.
This is a topic I would love to get into a little bit deeper.
Can I make one point, and that is, I've heard lots of stories of people selling their houses, mortgaging their houses to buy Bitcoin. Apparently you can get 100 times leverage on Tether. Okay, this isn't happening in the gold space. Bitcoin is the perfect bubble. I'm on the other side of this thing. I think it's a fantastic bubble. There's no supply response. You can't make more of it, unlike other bubbles, and so the price can go arbitrarily high. But let's not confuse a monetary medium, which the whole point is to be unvolatile, to make prices steady, and a bubble, which is fantastic if you can catch the wave right. It's wonderful. But, again, when you read about people maxing their credit cards out, mortgage their houses, it's probably not a good instrument for long-term wealth preservation, although I think it probably has more room to run.
Yeah, you probably will see, Dan, you probably will see the same if the gold cycle gets momentum, and also people will mortgage their houses to buy gold stocks. Yeah, but look, that's completely new territory here, and we have to accept that there is a huge and deep mistrust towards the global financial system, and it sort of articulates itself in different form and fashions. We prefer obviously physical gold in that perspective, but there is a new generation that also looks at different avenues. We'll see if it's a bubble or not. I don't know.
100%. But again, advice. Yeah. But you need a theory as to why Bitcoin is going to become stable and make prices stable in terms of Bitcoin. And there's no theory to describe that. I mean, we can talk about this for an hour, but my position is there's no theory to describe why it will happen. In fact, there's reason to think it will never happen. And that's what convinces me that it's a bubble, not a place in monetary medium. But I get your point. There are a lot of young libertarian thinkers who think that Bitcoin's getting out of the system, and that's why they're following it. And that is the motivation from behind Bitcoin was the irresponsibility by the central banks and the governments of the world.
We could debate this for probably an hour. Unfortunately, we only have like 5 minutes left, and I want to get into a really important topic, I think, in the mining sector, or in the gold sector, and that's the miners. We're heading into fourth quarter earnings. I just see that there's buckets and buckets of value in the mining sector. So, Henry, I'm gonna get you to lead this off. And again, we only have 5 minutes left, but I would love to get your thoughts on gold versus the miners.
Yeah, sure. Just very briefly, because I know everyone else wants to talk. Look, it really is. I guess the miners have inherent operational leverage in there. So if you're bullish on gold, and it probably makes sense to be more bullish and to be owning the more levered instruments. So on a directional view, then absolutely the miners, and the more dodgy the miner, the better, kind of thing. If you are just agnostic with the gold price, and we sit here in a year's time and the gold price hasn't moved, absolutely, as you say, there is a lot of value out there amongst a lot of them, kind of particularly at the top end, the majors. You've seen big de-rating, as I mentioned kind of earlier, in those equities, and if we were to have more stability in the gold price, on the one hand, combined with execution of strategy on the other hand, we should see very much clear, should see a re-rating of that. But what we just don't know, and was why you haven't seen dividends be largely increased by a lot of the majors, is we just don't really know. Post COVID, when things settle down, there's a lot of uncertainty in the gold price, and when we have that kind of more greater visibility, then I think we'll see the dividends coming out. And to a large extent, one may not see, until the dividends come out, one may not see that re-rating come. So free cash flow yields have risen, i.e. the equity have derated, but dividends have been pretty slow to respond so far, and we need to see that coming through before we get the share prices increasing. But definitely there's a lot of value out there, as you say.
So what do you guys think? What sectors and maybe what regions do you guys like? Especially for generalist investors. Who wants to add? Willem.
Yeah. Well, in our space, we are discovery investors, so we focus on the very early stage companies and the exploration side of the business. And it's remarkable that everybody always looks at North America, the Canadian listed explorers. That's how we started as well. The first 7 years of our fund, we started 2008. We ignored Australia. But in the last few years, all major discoveries, or 80% of major discoveries, all done down under in Australia. And when I talk to my peers, they always say, well, we ignore it, we can't trade this because our broker doesn't support it, or I sleep at night, But we started to really study the Australian exploration scene. And there's so many interesting stories out there, so many breaking discoveries. Last year, Our largest holding, the Grey Mining, up 1900%. Our second largest holding, Greatland Gold, up 1800%. And in the last week, we saw 4 new discoveries. I won't mention the names here because we're still building positions, but people forget how interesting things down under are.
Who else wants to take this? And
if we can go back to the macro quickly, I just want to push back a little bit on the idea that gold miners are simply a more levered beta to gold. And that is what a gold mine really is a spread trade between the input costs, which are industrial commodities, rubber, steel, labor, all those things, and gold. So what you really care about is those spread. If you think about the 2000, again, going back to what my distinction between a credit bubble and a monetary debasement, that was a credit bubble. And gold went up a lot, but the input costs went up even more. So gold mining was a terrible business to be in. And that's why you didn't get the expected leverage to gold miners to the gold price. I think going forward, if you have credit falling, especially credit falling in an inflationary environment, the way what happened in the 70s, right? That's when you get that spread between the input costs and the revenue increasing. It can happen in deflationary times too. In the 30s, gold didn't go up very much from 20 to 35, but the input costs went down 90%, and that's where your margin came from. So I think that what you've got to think about the miners is not where is gold going in a nominal term, but where's gold going in terms of the production costs of mining. And again, what determines that is credit growth. And if you think we're heading into a credit crunch or credit collapse, which, I mean, given that we're at the top of the largest credit bubble in history, I think it's a pretty good bet to have, or at least have some exposure to that bet. That's when the miners will do incredibly well. That's when we get that storied leverage to the gold price. And again, I think that's happening. But that, to be clear, that is a specific bet you're taking, not so much the directional price of gold.
I think if I might add on
here. Unfortunately, Marcus, we've ran out of time. I do apologize. This has been a fantastic conversation. I think we could, get it for another hour at least. But thank you very much for your time. Torsten, Markus, Willem, Daniel, Henry, thank you very much for your time and your thoughts on the gold sector.
Pleasure, Niels. Thanks for moderating.
Thanks for having us.